Let's talk about Nigeria's headline inflation in higher today at 20.77%, as the highest in 17 years, as the food and core indices also trended higher last month. The latest inflation data comes just a few days after the International Monetary Fund lowers Nigeria's economic growth forecast to 3.2% for this year on the back of headwinds that include a sinking revenue and rising debt services, among others. So what's the investment in markets case for Nigeria? My guest this is Steve Osho. He is a co-managing partner at Commercial Partners, which is an investment banking and securities trading services group. Great to have you here this evening. Welcome. Thank you. It's a Monday. Let's start it on this one. It's good to see you again, my friend. Yeah. It's good to see you. Steve, thank you so much for coming through. Let's start with inflation. 20.77. Was that in line with your expectations at Commercial?
Yes, very much in line with our expectation. If you look at the numbers since the trajectory upward trend since the beginning of roughly around the first quarter of this year, you've noticed that we've seen that upward trajectory in inflation, and it's coming on the back of the high cost of energy and the food prices, which are actually the most critical indexes under the CPI. And the last number that came out today, 20.77, is actually not far from what we're expecting in terms of inflationary number for this quarter. And I think it's as a result of why we're seeing a lot of global headwinds across the world, and Nigeria is not an exception from that numbers. And the reason why you've seen that aggressive movement and hawkish stance by all the central bank of this world, and going by what even the central bank did at the last MPC meeting, it shows you that we are trying as much as possible to be able to tame the aggressive stance or movement on inflation. This is September inflation heading higher. This is likely, you think, is going to give what you call the impetus or the bullet for the central bank to fire the MPR again in November, which will be the last meeting for the year. I think from the MPC communique last time, it's quite obvious where the central bank governor actually stands and the committee. I think it's going to continue in the meantime, but I think they're going to look at the feed-off effect of what they did the last time and how that's actually impacting 150 the numbers. 150 was in July. Yes. That brought the anchor rate September, to 15. Yes, 150 that brought the anchor rate to 15.5. Do you think 150 will be again in November, or going to be smaller than that? I think it's a tough call at this point, considering the fact that the effect of the high number of anchor rate, interest rates, is going to feed off from the borrowing rates or the lending rate from the banks. And at the same time, actually might slow down the manufacturing, industry. Yeah, exactly. So we have to be very careful, because it's a very treacherous place we have right now, and we have to be careful to make sure that we are actually not causing more problem in terms of actually trying to grow the economy. Interesting, but again, here is your report last week on Macroeconomic and Markets report. Give me the highlights of that report. You touched on quite a number of issues. Yes. Yeah, the report was actually very, very broad. If you look at that page, if you look at that report broadly, but I think one thing that is very key. I don't know if you've seen the latest report from the lending tree. The lending tree is actually an online lending marketplace, platform. Great. That predicted that, or that says that a lot of American citizens, or 32% of American citizens, are actually struggling because of inflation to actually pay their bills. And I think it's very important that we actually dwell on that. So the report actually overs around all the issues that we have, in the global macroeconomic space, coming from US, how US Fed has been very aggressive in trying to, tame inflation. We've seen them hike rate 3 times now. They've done 75 basis points, and you've seen that anchor rates of the Fed rates actually hovering between 3 to 3.25%. And you've seen, the mini budget that was, the debt mini budget that was actually released by the UK government, which has caused a lot of problems in the market. You've seen how they're trying to, cover or make sure that they provide for about 40 billion pounds and 60 billion pounds to cover tax cuts, and trying to protect the energy cost of the household. And you've seen the effect of that, how the pounds have actually snowed against the US dollar, coming to 1.04.
These are external vulnerabilities.
Yes.
But we do have our own, we've got our own issues to deal with, don't we?
Yes, we do. I think all the economy across the world have their issue to deal with. There is no island in terms of how the global economic headwind is actually affecting everyone. So you've seen that in how Fed is addressing that. You've seen how UK, BOE is addressing that. You've seen how ECB is addressing that. You've seen how Central Bank of Nigeria too is addressing that. So it's across the globe, and we all know the reason. The Ukraine-Russia war is part of the issue. The supply chain issue that we've had over time since the COVID-19 and how we're emerging from that particular point has been an issue. So it's a whole lot of other issues that have actually, snowballed into.
I'm looking at what you consider, therefore, an investment reality case for Nigeria, for example.
Well, investment reality case for Nigeria is a bit tough right now. If you look at the amount of money that actually came in through the capital importation for the second quarter, it tells you the story. I think we have about $1.5 billion, a reduction from what we witnessed in first quarter. And if you look at that amount, just about 40% of that came in through FPI. So another 40% came in through other sources of investment, which means that, maybe some people trying to move money to capitalize some of the agencies that have in Nigeria. And just, roughly about 10% came through FDI. So it tells you the story, and it tells you the challenges that we have, and that's the reason why we have the external reserve actually struggling at this present level.
And exchange rate as well.
And exchange rate as well.
So if you look at the investment debt and overall fiscal balance, based on what we heard in the last few days from the IMF, World Bank annual meetings about whether we're renegotiating or restructuring our debt, looking at our fiscal balance in terms of what we're doing on the current account side and trade balance side, what's the investment case now? You say it's tough. Like
I said, bossing is very tough. And the reason is because Nigerian case is a bit, I don't think it's actually tougher than the rest of Africa. Because if you look at the entire chain of sub-Saharan African, it's a tough terrain right now. And the reason why is that we have security issues, we have the inflationary pressure that is still there, and we have the fiscal pressure. So all of these things are things that we have to look at as a country and address all of those issues. Because without security, I don't think a lot of investors or investment will come to Nigeria. And inflationary pressure is another thing that's actually causing a lot of issues. And if you look at our real, returns rate in terms of where the yield curve is, although we've seen an aggressive movement in terms of yield actually going up now, but you see, inflation coming at 20.77, and we see our longest dated instrument trading around 14.5, 14.75 levels. So I think it's a challenge, and we have the fiscal pressure. The fiscal pressure is coming from the federal government side, where there's no prudence in terms of how we are accessing or trying to manage our fiscal cliff. We have over 40 trillion in debt. And without adding the 20 or over 20 trillion in ways and means by CBN.
So in terms of, what needs to change, fundamentally speaking, moving forward? I
think we have a lot of things to change. We have to look at how we actually come out in terms of our fiscal planning, fiscal planning, and in terms of monetary policy.
But we've got some plans. We've got some plans in space. We've got a debt management strategy. We have a fiscal strategy paper.
Yes.
Are they good enough, or are they just good on paper?
I think they are good enough, but there are a whole lot of other issues that we have to look at. I think the problem we have is not just structural, but it's a whole bunch of other issues that we have to look at from the monetary policy side and the fiscal side. And fiscal side means that we have to look at a lot of things that has to do with the states, and and the policy that we have to enhance those, and how to see how we can actually manage some of the budgeting that we have going forward. I think a lot of prudence have to go into that, and a lot of thinking has to go into that, because the situation right now is actually very there.
How much of these fiscal issues will buffet the market? Give me less than 1 minute of that. What do you think?
Sorry, what
moving forward, these fiscal headwinds.
Yes.
How much of impact would that flow into Broad Street, where the financial marketplace is, where you work?
Well, we've seen that impact. We've seen how the government is trying to raise money to finance some of the budget deficit. And we've seen that from the budget deficit, we're actually going above the fiscal,
threshold.
The threshold of the fiscal arrangement that we have.
Yes, fiscal responsibility.
Responsibility act that we have. So which means that is a lot of pressure that's going to come to the market, which means that government is going to borrow more. At the same time, we have to find a way to make sure that we have a transparent FX regime. That's another thing that's actually causing problem. Why we're trying to tame inflation as it's actually aggressive.
Okay. This conversation is not over yet because we're not out of the woods yet, as it were. Yeah. So we're going to keep knocking on your doors. Okay. So that's how I'll put it. Knocking on your door next time. Thank you so much. Really appreciate that. Your insight into those market issues, and have a wonderful evening.